My name is Anthony Fatsis, and welcome to the What the Finance podcast, where we interview finance, trading, and investing experts to help you understand current market trends and learn about the intricacies of new and existing assets. If you enjoy the podcast and to help with the YouTube algorithm, please like, comment, and subscribe. It really helps with the podcast. That means we can continue to get amazing guests. Thanks again, and I hope you enjoy. So yeah, Joe, thank you so much for joining the What the Finance podcast to talk with me today. And just on to my first question, what do you see as the greatest issues in the current state of capital markets?
Oh, wow. Okay, great question. I would say that the overarching capital markets issues are structural. I think that participation in the capital markets is at its highest level among the general investing public. More funds and more VCs and more private equity firms in the private side are able to raise money. We're raising money in the public capital markets at unprecedented numbers as well. So participation is way up. The question is, how do we go about increasing participation, and how do we make sure that earlier stage entrepreneurial companies are able to be well capitalized, and as a corollary or not of lesser importance to that, how do we make sure that the investing public gets to participate in what are high growth, highly profitable wealth building investments? So to me, the major state of affairs is how do we restructure capital markets to make that more available to a more highly interested population of investors and a more highly interested population of company owners and early stage and entrepreneurial companies. So that's the major tension. I think everyone has their attention on that, including obviously Dream Exchange. We have majority Black ownership. How do we enfranchise larger populations of people in communities that have not really historically participated in finance? So I could that one question we could take an hour. That's a great question, but primarily that's what I see as at the very top of this capital markets discussions that I have certainly on a daily basis.
Yeah, definitely. And from what I've seen, like I've been applying for jobs, for graduate jobs, and what I've seen that there's really few agents that have so much control over capital, and they basically have most of the capital in the market, you could say, or a majority like BlackRock, State Street, Vanguard, and there's massive VC firms as well. So do you see that as potentially an issue, that these companies have so much control over what companies are successful early and later stage?
Yeah, that hits exactly the point I was making. So it's both a private and a public capital market issue. The fact is that in the public capital markets, at least the US, there's about anywhere between 36 and 40 trillion dollars of equity value in the marketplace. Now that's traded in multiples every year, but 80% of the control of public capital markets are in the hands of institutional investors. So it's highly concentrated amongst fewer firms. And a similar phenomena exists in the private markets, where you've got the BlackRock and State Street and even in the VC firms, KKR. Those firms tend to have the financial capabilities to really well capitalize the earliest stage companies. Now, that phenomena, the average investor is then participating in something that other people chose as the investment. So at one time, we had a much more diverse marketplace where early stage companies could get very small VCs. I mean, KKR started that way. They were a small VC and then they hit it big. So the opportunity to hit it big still exists, except that if you're an early stage company, you almost have to go to what I call the usual suspects to be well capitalized. So in terms of is it a problem? It's actually an infrastructure that's working quite well. The problem that exists is we're not expanding participation. We're not making the next BlackRock, the next State Street, the next KKR. And we're also, by virtue of the fact that we're not doing that, it becomes increasingly more difficult for the early stage company to get broad acceptance and participation. So if you're not, I use this analogy sometimes, if perhaps it's a bad one. If there's an international audience, my apologies in advance. But I use the analogy as like baseball in the United States. There's kind of the minor leagues, and fewer and fewer teams are selecting amongst a smaller pool of potential major leaguers. So if you're a really good player, it's increasingly more difficult in the capital markets to be recognized and to be chosen. And I see that's what I mean by a structural problem. Like, we need to expand the proverbial minor leagues and get more money into those smaller companies and those people who have the potential to become, the next Microsoft. We use Microsoft as an example. Microsoft was a $61 million IPO in 1986. That's not a lot of money. It's a lot of money. Look, relatively, $61 million to most entrepreneurs is a fortune. But when you look at it and you think that $61 million IPO has created what ostensibly is the world's largest software and computing company that ever existed, how many Microsofts exist in the marketplace today with the next best idea? And how many of those, even though they're small, are getting the attention of enough people? If BlackRock takes a pass on Microsoft, then Microsoft is not capitalized. So that is what you're saying about the larger players being able to control more of the marketplace. That's good to the extent that if they find Microsoft, they're well capitalized. It's not good to the extent that if you have the next best idea, it's harder for you to find capital, and it's a more difficult process, even though we're not really disenfranchised. So it's a difficult problem to isolate, because I'm not demonizing the large investment companies, nor am I demonizing the large public companies. It's just I'm concentrating on how we can get more market speculators. I love traders. I love people who see a good idea and want to market speculate and be able to trade the stock up and create trading strategies around smaller companies that allows them to build their wealth. And, in my area in the north suburbs of Chicago, most of the expensive homes are owned by former traders. And we're not producing lots of those people as well. So that's where I see it's somewhat problematic, not because it's not working. It's not working for everyone. That's the point.
Yeah, and I think as you said, it's not, it's almost like the winners taking all. And we've seen that with the startups that potentially get funded as well. So it might be, if you're from Harvard, if you're from MIT, there's that classic, or, you're an Goldman Sachs, there's that classic, you definitely, or maybe not definitely, but there's a very high possibility that you'll get funded over people maybe from the non-target university. So you could say, or colleges, you could say it's linked to that as well.
Right. And when you really look across the board, there is that pedigree that adds a certain credibility in most cases. It's the vast number of other cases where pedigree, not coming from Goldman, not coming from, JP Morgan, not coming out of your conventional channels where the finance people are superstars. This is a perfect example to your point. Chicago has a group of investors. They're called the Hyde Park Angels. So the University of Chicago is in Hyde Park. Well, 30 years ago, Hyde Park Angels was just a bunch of MBA students from the University of Chicago. There's a pedigree there, certainly. But, they decided that this education that they got would enable them to really make smart VC choices. And they started very small. Now they're widely recognized, but those types of entrepreneurial breakthrough investment groups, as well as entrepreneurial breakthrough companies, don't have a similar audience that they had in the 1970s, 1980s, even in the 1990s to some degree. We have extremely good data and slides in our webinars that we show the collapse of the small public company marketplace in the US. It's shocking to look at the data where at one time between as many as 900 small company IPOs occurred annually. That when we say small company, it's $50 million IPOs. We average maybe between 4, we've had as many as 10. So like we've gone down by a meteoric decline, which is exactly what your point is that there's a smaller marketplace, not because there aren't good ideas, not because there aren't good people, not because they're not quality and capable, but because market structure has designed it in a way that you need the pedigree, you have to pass muster at BlackRock, and then if you have, of course, you're given carte blanche. And I don't even know what the statistics would be. How many of the BlackRock investments on their own momentum succeeded versus if you have an unlimited amount of money, you can almost make any idea work. So yeah, you're spot on with what you're looking at, right?
Yeah, and you could say as well, like going back to the baseball analogy, hopefully I get it right. A lot of these investors are looking for the home runs, so they're not looking as much. For those small companies, it might not be a unicorn, but it could still be a company that grows 5 times, potentially even more, if it starts from a low base.
Yeah, I mean, I have a lot of people that I've worked with, a lot of investors throughout the years, and the VC environment is looking for 10x. They're looking for, how can I get this investment to go 10 times my investment? And what's very interesting is there are a vast, broader number of investors who would be very happy with 2x. Okay, if you do 2x after 5 years, that's a 15% internal rate of return. And there are a lot of very stable, good companies who can easily produce that. And therefore, that broader audience of investor who may have an appetite for that don't have the menu of those choices. And the guy who's going to double in value, I mean, think of the alternative. The alternative is you lose your money. So if you've lost your money and you get 0x, that's bad. On the other hand, risk reward people do that analysis where, oh, well, it can do 10x, so therefore let's take our chances. How about we minimize the risk pass off and say you're going to do 2x, but you're almost certain to do it.
I think that'd be a super interesting way to look at investing, as you said, rather than just looking for, because as you said, 15% return per year is great. It's almost double the sort of annual return of the stock market. So
right,
that would be something that most investors would be, I think, pretty happy with.
Right, exactly. And we've piloted organizations like that, where on a consultative basis, we've really just helped them make certain decisions. And the one pilot company that we helped as our star example was about that. They were about 18% internal rate of return. The earlier investors did much better. They were a private company. They graduated to the public markets. The earliest investors did 7x, okay, after 3 years. Everyone else did about 2x after 5 years. So that's a very successful story. And a small company with, started out with maybe 60 employees, then they had 400 employees. So the growth throughout the kind of the ripple in the economy from this activity is of vital importance. And here's the other interesting thing. There were market speculators then. There were traders who actually were able to make money on add that public stock to their menu, even if they didn't get in the private market.
Yeah, so that's super interesting. So you mentioned before as well at the start that there are a lot of people who are disenfranchised potentially for investing, in the public market in general, let alone investing in private companies. And they could, maybe minorities or potentially people from lower demographics as well. Why would you say, why do you think people are disenfranchised sometimes?
So I think there's a myriad of every time you have to go into the past, the question that we're always asking ourselves is, how deep into the past shall we go? And are the problems with the system, or are they problems with human choices? So there's a myriad of answers to your question, which is, first and foremost, there are a lot of human choice errors and certainly bad behavior by human beings throughout hundreds of years. So we tend not to go down that lane, because that would be a social betterment organization, which coincidentally we become by looking at how does the market system work. And so the answer to what disenfranchising is, there's a couple of things. First, and this is of vital importance, is financial literacy. So there just hasn't been anyone pushing interest into all communities. I wasn't raised, in fact, by a set of parents who had a large stock portfolio, but it was mandatory. I was going to college.
Yeah.
I was the first. Well, my brother and I were the first people in our family to graduate from college. I got a CPA certificate, so my financial literacy was quite high. Now, so financial literacy is one of the system-wide problems that we're working to help alleviate. But the other one is this: it's a relationship-driven marketplace. So when you look at relationships, if you are someone who came from a pedigreed school like you were addressing, and comes from a marketplace where your friends and your associates, your friends and family raise, includes a lot of people in your Rolodex who are more than able to help you succeed, well, it kind of gets easy. And there are communities that are disenfranchised because they don't have the relationships. So by opening the marketplace, we have this ability to formulate relationships that don't exist. And that's primarily, I would say, those two are the top two in what we're trying to address as a system-wide problem.
Yeah, definitely. And that's super interesting. And I think I can't remember the exact study, but I read something saying that, if you look at the people who are going to be, more financially successful over their lifetime, it's ownership of assets and ownership. You could say it could be stocks, it could be portfolio, property, it could be anything. But those are the people who've really, you look at the last 50, 60 years, those are the people who've really benefited from it compared to other people who haven't owned anything.
Yeah, I say this all the time. It's two words. I own. not I lease, not I borrow, not I participate. It's I own. Mm-hmm. And that ownership, in fact, especially in corporate environments, in private company and public company environments, the data is overwhelming. And for example, in the United States, the Securities Exchange Commission and the Department of the Treasury saw the decline of small public companies. And 10 years ago, they commissioned a study. They spent an enormous amount of money studying the problem. And out of the study, they discovered that 92% of job creation in a company happens after the public offering. So if you have a company of 100 people, a good small company, and they're able to access public markets, you've now created 1,000 jobs. Okay, so that's not my data. That's the U.S. government's data. Now you take that into a community where we're looking at diversity and we're looking at the disenfranchised groups, and you factor in that the New York Stock Exchange has been in existence for approximately 230 years. In that 230-year time frame, there has been one listed company owned by Black people in the United States. Not 1%, one company. Of the tens of thousands of companies. So now let's take those two statistics and marry them together. You now have a job growth and real jobs, not no offense to to McDonald's, but people try to solve this by going, welcome to McDonald's, may take your order, and you get a minimum wage job. Fine, that should be encouraged. On the other hand, what about the human resources department and the career planners and the marketing people and the treasury and finance people and the production people and quality control, and the list goes on, public relations, sales. Those are career path opportunities that don't exist because one of the communities in the United States is absent from public capital markets. Because if you're in a public capital market and you have a public company that might be headquartered in a diverse area, you're now creating 10 times the number of job opportunities that are career path jobs, living wage jobs, raise your family jobs, make a community job. So that is a problem. That is a system-wide problem. And that system of, now we go back to, if you don't have the relationships, no matter where you are, this is a colorblind problem. Relationships are relationships. So if you don't have the relationships, your chances of expanding, succeeding, and living that dream, sorry to all the non-Americans, but the American dream, it become increasingly more speculative and difficult to accomplish.
Yeah, and I think it's especially true when you start your own business. Those relationships you have are huge.
They're vital.
It could be the success or failure, literally, of a business where, basically almost everything has to go right if you want to start a public company. It's almost how it works. So if you have that one relationship, well, that could be the difference.
Yeah, and sometimes, there's that 6 degrees of connection where we're supposedly six people away from anyone on the planet. Sometimes it's the effort it takes to get to the sixth person. Okay. So, someone who knows someone who knows someone. So the strategic relationships, those relationships can become the financial relationships. So what is the strategy for which one employs as an entrepreneur? And this goes back to the investor as well, because, I was not someone who was permitted, not because someone said you're excluded. I wasn't permitted to invest in Uber before it was public, or Facebook, or one of the other, unicorn companies where if you were, employee number 6 at Facebook, you're now a billionaire. Well, how did that occur? Well, it occurred because the strategic relationship, I know another person who might introduce me to Mark Zuckerberg when he just quit Harvard University. And I would like to be the director of human resources. That opportunity requires a tremendous amount of looking for your needle in the haystack. Whereas the more we open the market, the more we shrink the number from 6 degrees of separation to maybe 2 or 3. And that is the opening of the marketplace. And it really is the opening of the marketplace for the investor as well. They just don't have access. When we surveyed words that were important to investors and entrepreneurs alike 5 years ago with our company, we were like looking for what's the word that everyone agrees is of vital importance to them as an investor or as an entrepreneur. And the number one word, hands down by tenfold, was access. The investors don't have access to the companies don't have access to the investors, the companies don't have access to strategic help, they don't have access to all the resources that both of those groups need. And if we provide a more democratized way of allowing for that access to occur, well, then we're facilitating the relationships in a way that is not, it's who you know, not what you know. And the more we get to actual production and the good idea gets funded, the better off we all are as a society, as a group of people. I would love to know that the next cure for cancer is not getting kicked to the curb because he just doesn't know the right people to capitalize his company. I want him to get all the money he needs to help me and my children and all the future generations not die from cancer. So it is a relationship, I guess, democratization as much as a financial one.
Yeah, definitely. As you said, if you provide this opportunity for everyone in the world, and there's going to be so much more advancements than what we currently see if it's only 10% of people who have access to it,
Right.
or even just America in general. Yeah.
Yeah.
So can you talk a bit more about Dream Exchange? Because I know it's a platform that connects obviously investors with startups or businesses. From there, is it like, can people, is it a primary market and a secondary market, or how does it work?
Good. So let me give you the overview. So Dream Exchange it's a stock exchange in formation. We're not licensed yet. We're in the process of what they call building the pipes. And there are multiple stages to what our future development is. So the first stage of our development, which we're in right now, is actual construction of the software engineering of a stock exchange, an electronic exchange. But that is, and it's our primary function right now. But what for purposes of what we're talking about right now is there's 3 more stages, and the other 3 stages are working, once licensed, to developing an IPO market using our brand. So new public companies that would be part of the brand of Dream Exchange. But really what's squarely in this conversation is we're also developing something that there's a new piece of legislation that has been, actually, we wouldn't even be talking about it as legislation right now. There's a bill called the Main Street Growth Act. We worked heavily with the US Congress on this law. And in 2018, in fact, it passed the House of Representatives and the Senate unanimously. And what the bill does is it creates a new type of exchange called a venture exchange. And these are exchanges, and we're pioneers in this. They're specifically designed to accommodate very small companies to kind of replace that structural problem we've been talking about in helping the small private company become a small public company. So that's kind of phase 3. But in front of phase 3, which we're actually actively doing right now, is where is the market for this? Where are the potential investors? Where are the potential companies? So we've actually created a social media platform, and it's what's called DreamX Connect 1.0 right now. And what it's intended to do is allow access between strategic relationships between the companies, between potential investors, or even, sometimes in the earliest phases of a company, a strategic relationship becomes a financial relationship. So for example, the group of retired, this is a real world example, a group of retired executives from Procter and Gamble. They all exited well from years of working at Procter and Gamble, 13 guys. They saw this new product. They initially were consulting the company, and it was a consultative relationship. And eventually they ended up raising about $13 million in seed money. And some of them actually became board members and executives, but it was born out of the company and those particular individuals having access to one another to look and to actually examine the workings and guts of the products in the company. So DreamX Connect is really intended to allow a company to put itself out there. It's a social media. You can post things. You can put your company's profile there. There's menu driven, just like Facebook. What is your marital status? Well, your marital status is less relevant on DreamX Connect. But what type of company, what round of funding are you in? What are your products? You can post videos. You can post pitch decks. You can put anything out there that you want to make the public aware of your company. And then there's another menu for the strategic people. Like, are you an investor? Are you a VC? Are you M&A consultant, and they get access to one another in DreamX Connect. We're doing that right now. So this is something that can be done about the situation now. And our hope is that as the population, I think we're up to 2,000 identities in there. We haven't even marketed. Like I said, it's DreamX Connect 1.0. But we're hoping to get thousands of people in that platform, out of which will come the interested, educated venture exchange investor and venture exchange listings. So it's a marketing program we have in place right now that is intended to do financial literacy, educate people on private and public capital markets, get the strategic relationships established now, so that when we do open the venture exchange, which is, at least 18 months from now, we're not then launching, well, who's interested in this? There's a tremendous amount of interest. Actually, a year ago, we had a couple of press releases. We had almost 1 million people going through our website, which tells you the interest is very high. This conversation that you're having right now is extraordinarily relevant. It is perhaps the most relevant capital markets discussions that anyone is having today. So Dream Exchange is a stock exchange in formation, specifically being designed to address the market structure problems that exist for the small company investor and the small entrepreneur company.
Yeah, well, I think it would be super interesting. Like, obviously you provide liquidity for equity from, is there a stage at the start? Like, is it, or could it be seed stage, like pre-seed?
Seed stage, yeah, absolutely. Yeah, so perfect. The eligibility for the exchange, we can't publish yet because we're not an exchange. But yes, the answer is if you're a small startup, you're at seed stage. There's a menu of things that need to be accomplished to enable that company eventually to get public money. So this is help pre-public that helps educate and helps inform, so that those entrepreneurial companies at seed stage are headed on that path. An interesting, I read this recently. There's an interesting article that talked about a Harvard MBA program where in the early 80s, they took a survey of graduates, and they asked them, one of the questions they asked them was, have you written down a career plan? And I think that only 5% of them actually took the time to write down an entire kind of personal business plan. And then 20 years later, they got the alumni together and they surveyed and they looked at, what was the career of those who wrote down a plan versus the other 95% who didn't. And the 5% who wrote down and made a plan had combined net worth, or their net worth was 5% was more than the combined net worth of the 95%. So the importance of making a 2, a 3, a 5-year plan of getting started on where you want to be 5 years from now is of vital importance. It's exemplified in a career path with Harvard MBAs. It's even more so if you don't have the pedigree. If you're traders, a lot of traders and investors, they don't really have that type of, I'm looking at this 5-year plan. What should I be doing? How should I be allocating the I own so that 5 years from now, maybe I want to harvest some of my wealth? Those planning stages are what DreamX Connect is all about, is to help people get started on setting their proverbial vessel in its right pathway so they sail and arrive at their destination. And that's we're doing that now, but I don't think that's not something we're ever going to give up, because obviously that's our inventory of customers. And it's currently something that really doesn't even exist. I don't think there's any consolidated place for this market. And naturally, what's born out of that? Well, an initial public offering, or initial venture offering, as they'll be called, and secondary trading. See, this is what's really important. You touched on this. Where does the liquidity come from? If you've started a small company and you've gotten successfully through round A and B or seed round, and you have a bunch of private investors, what is the exit? How do they get out? Well, you're then in a conundrum, because either you have to sell the whole company to Big Co, you have to sell it to a private equity firm, maybe you'll sell it to your management team and do a management buyout, you'll do some other recapitalization. But the option of creating liquidity in a public market for a small company currently doesn't really exist. So that secondary liquidity of maybe someone wants to stay in the investment longer, or maybe someone wants to exit. Well, the choice, the freedom of choice that comes in the public capital markets is not a negotiation that needs to take place between a private investor and the company owner. The shares are listed, they buy and sell as they determine their confidence in the investment, but also their personal life. I can't tell you how many times, and I've been raising capital, for 30 years, how many times private company owners have called me and said, we're doing great. We're made all of our milestones, but our earliest seed investor who invested 100,000, he's willing to sell for 100,000 because he wants to put an addition on his house.
Yeah.
Has nothing to do with the company, nothing to do with their success. And now this private company owner who lacks liquidity in his company is faced with needing to make a deal to sell part of his company even if he's a nice guy, he doesn't have to, because once you're in a private investment, you're in till it succeeds and exits, or until it fails. But usually these company owners are very good natured people. It's like, oh yeah, I'd like to help him. He helped me when I needed him. So I've had many of those conversations, and what's needed is an exchange environment where secondary liquidity is available without negotiation. There's a publicly quoted price. The companies are giving investors transparency. You can find out all you need to know about the investment, just like you can a larger public company. And the quotation of the stock and the ease of buying and selling it is in an exchange environment, instead of a relationship driven, I need to now find another investor to replace my investor conversation.
Yeah, definitely. That's super interesting. So one thing you could say as well, you said there's lots of interest for investors investing in early stage startups or startups in general. And you could say that might be linked to the current monetary landscape that we have at the moment. Low yields. These investors are really looking for returns, and potentially higher risk markets similar to startups and emerging markets as well. Do you see there are risks that, say, in the near term, we see tapering and there might be higher yields in other markets that people might not be as interested in investing in startups, or you think there'll always be that interest?
I think the interest is been fairly constant throughout the years. In fact, I would say that this is a very interesting survey phenomenon. I'm 55 years old, so I look at myself. I'm kind of on the cusp of the baby boom generation. I'm not quite in that, and I'm not quite in the generation just after that. But I would say generationally, the younger investor, the 20 to 50-year-old investor today, has an extremely high risk tolerance. They're very interested in the unicorns. They're very interested in the market volatility that happens when, like recently we had the whole market speculator short selling GameStop, controversies. They're very interested in that. And I would say that financial technology has driven a marketplace where the risk tolerance and the informed investor is like no other time in our history. You can get on an app, you can Google, you can find out so many things about a company that in the past, even when it was just email, okay, where they had to email you their pitch deck. Today, you can find out virtually anything about a company using financial technology, as well as using, the Internet of Things. So my viewpoint is that the earlier stage companies that are continuing to outcreate, I guess it's the limitation would be, when will human beings stop trying to invent a better wheel? And I don't ever see that stopping. I'm inspired every day looking at the interesting solutions that human beings come up with that are necessities to our survival, to things we all need. And there's literally tens of thousands of small companies that have a better mousetrap. And anywhere from entertainment and online gaming all the way to medical devices and cures for biological illnesses. Okay, the landscape is enormous. It's not just the tech companies in Silicon Valley anymore. And I think that investor risk tolerance for that is growing at an increasingly wider pace, which incidentally is another purpose behind the Dream Exchange, because that risk tolerance does need oversight. It needs someone to protect the investors. So in fact, last month, the Securities Exchange Commission created a rule that said, if you're a public company and you're not listed on a stock exchange, you're an over-the-counter company, and you're not complying with investor transparency, you're not complying with providing all the boxes checked on your investor reports, well, we're going to ban any brokerage from quoting that stock. Why? To protect the investors. This is where all the scams and the pump and dump schemes come from. They come from, they're not really compliant, but they are a public company, so I can go to a broker and I can buy some shares. Well, we at the Dream Exchange are an intermediary to provide oversight to help the investors cull through all that information. We're there to protect the investor, to assure that the investment opportunity is a legitimate one and that they've gone through our process so that they've gotten a vetting to be listed on an exchange. So I think the risk tolerance of the next generation inspires me. And sometimes it isn't even so much the risk tolerance. I have a whole lecture on risk reward and what that means, because it's one of the more misused terms that exists, where what's the risk the sun's not coming up tomorrow? Well, there's a chance. On the other hand, if I were a betting man, I would say there will be a tomorrow. You can start to evaluate companies that way. If you are selling sand and you're in the desert, there's way too much supply and probably not sufficient demand. On the other hand, if you're selling 100-foot span of beach in Miami, Florida, that sand is very valuable. Okay. So it's about what's the risk tolerance? Well, it's a lot less risky trying to buy a beachfront property in California or Florida than it is to buy 1 square mile of land in the Mojave Desert. That's not risk reward. That's about the guts. It's about the actual look and examine what the purposes and production of the company are. And that removes all risk if you're properly evaluating the opportunity. And that's what the Dream Exchange does, is help to funnel what the opportunity actually is, so the investor's risk tolerance, albeit very high right now, is more concentrated into making more informed and correct decisions.
Yeah, it's super interesting. And one thing you mentioned before is unicorns. And we've seen over the past, you could say 20 or 30 years, as VCs gotten more popular, there's been a lot more unicorns coming through that, you could put an example, maybe WeWork, or a lot of these ones that raised a lot of money when they probably didn't have a viable business model behind them. Do you think if we take the next step and, provide more greater liquidity from, other investors, do you think that could be a risk that they sort of hyperinflate the value of some of these startups to the point where, they're worth billions, but they maybe shouldn't be?
Yeah, that's actually a great example. So, WeWork wanting to go public, wanting to be the unicorn, the inflated values The market is an incredibly smart place. Okay, the people who vote with their pocketbooks are incredibly astute, and exactly to our original discussion, which is, well, who cares if 50 VCs got together and put a $50 billion valuation on something? What is the market actually going to say about it, both as a business model and as an investment opportunity? And part of the go to public process happens to reduce that risk. In fact, so we wrote a white paper, and thank you to the UK, because Oxford University created a handbook on IPOs. And chapter 9 is myself and our director of research. We're the author of a white paper called Lower Visibility Markets Acting as Stepping Stones to National Stock Exchanges. So what happens? The valuation, it goes on a mapping process. When you skip the mapping process, you get WeWorks. When you skip the mapping process, you get Theranos, okay, which is another enormous disaster where the private investing organizations weren't really looking carefully at the disclosures within the organization. Same thing, similar with WeWorks, perhaps not quite so controversial and potential for criminality. It was just a bad valuation. Not even a bad value, but bad investment choice. WeWorks has kind of got a wonderful business model. It just wasn't worth the value that it was purported to have. So, and at some point or another, the unicorn marketplace, you have to ask yourself, and this is right on your point. If we're only looking for unicorns, at some point or another, you have to ask, how much is enough? Is a $25 billion valuation enough? Do you have to have 50? And not to listen, I'm in the financial markets, so building wealth and owning things and having prosperity is my middle name. That's what I want for everyone. But there's a famous quote by Ray Charles, and he said, someone was asking about his finances and why he was kind of aloof and didn't pay careful attention. And he said, you can only eat one meal at a time. You can only drive in one car at a time. You can only stay in one house at a time. And, the point being, do you need 7 homes? Do you need a $50 billion valuation? 25 is plenty. WeWorks needed a correct valuation, and they would be a very viable, growing organization of something needed. In fact, today, when you think about it, WeWorks commercial office environment, the commercial office environment has a huge shift. Look what we're doing. I'm not in my office. I'm actually doing this from my home office. How does that affect WeWorks? Well, in two ways. You could look at it negatively and say fewer people need, the office spaces that WeWorks was creating. On the other hand, you could look at it and say, WeWorks now has an opportunity because there's tremendous numbers of commercial office spaces that don't have the 1,000-person law firm occupying them. Danger and opportunity. Look, we're telecommuting, we're using video spaces, but for WeWorks, there's an opportunity, which would be there's thousands of square feet of commercial office space that's now available, which would reduce their cost of doing business. And for those who still, we used WeWorks. It was cool. It was fun. There was coffee and there was a conference room, and we had a lot of people into some meetings, and we didn't have to have a large office space downtown that we paid monthly rent for. It's a nice business model. So the question becomes, what was WeWorks disclosing? What was the substance of their plan? What were the future macroeconomic risks and rewards that they needed to fully examine? And again, is it, I'm not sure if I got cut off on my Ray Charles quote, but is 25 billion or 10 billion valuation enough? And we've really focused on the unicorn environment. very few companies. I was involved in a unicorn. Okay, I was the lawyer who was, part of the 4-person team that formed Archipelago, which is why I'm in the stock exchange business. Archipelago was really among the first 3 companies to match electronic trades over the internet. Okay, well, being a pioneer in that environment, I saw valuation go from a couple million to 500 million to, now Archipelago is called NYSE Arca, the New York Stock Exchange electronic trading. One of the main carriers of stock exchange traffic is Archipelago. The New York Stock Exchange wouldn't exist without it today. My former client and business partner became chairman of the New York Stock Exchange. That's a unicorn. Many people have become billionaires out of Archipelago, and there are characteristics. And if you're not looking carefully at what a unicorn is versus a 15% IRR, okay, you don't have to sell 1,000% internal rate of return to be a very successful company and have wealth. And we've focused on those unicorns in a way that has pushed the envelope to where they have to have 50 or $100 billion valuations, which is totally unnecessary. There just are not that many companies worthy of that type of valuation. So it's an exaggeration that with correct, transparent information to the market, you're a good player on the team of public companies. Be that, fulfill your role. To use the baseball analogy, the player's not going to be in the Hall of Fame the next Babe Ruth, but he's going to be a very good major leaguer and worthy of our investment money and our time. So yeah, I love looking at those cases, and I love looking at that environment because it's exciting and fun. By the same token, it ignores your audience. There are probably thousands of people who are entrepreneurs who are trying to figure out, how can I have a multi-billion-dollar valuation? Well, how about a $300 million valuation? That's pretty good. A lot of people will do well with that one.
Yeah, definitely. And so, Joe, thank you so much for joining the podcast today. Just on to my last question. What is one message you'd like listeners to take away?
So I thank you for having me. I love doing these. It inspires me. So my one message is this, in terms of both who your audience may be. If you're an early stage investor, you're a trader, you're an entrepreneur, you're a small company owner. The two words that will produce the words I own are 2 other words: never quit. That's my message. I've been working with entrepreneurs and small investors, and the only time things go bad is when people give up. So if you have a good idea, or you're a trader and you've taken some losses, just don't quit. You'll figure it out. It takes fortitude. It just takes sticking in the game. Problems come up, things happen. That's just life. But if you just never quit, that's our market. Those are our customers. I want people who are fighters, who want to just keep working and keep making their environment and the world a better place. And if we give up on that, we're giving up on ourselves. So never quit. That's my message to your audience.
Great piece of advice, Joe. Thanks again. If anyone wanted to get in contact with you or follow your, dream exchange or your journey, what would be the best way for that?
So the best way to get us is our website is dreamex.com. And from there, you can find everything. You can find DreamX Connect. You can find ways to get in touch with our senior management. You can find our investor pool. We're still in our founders round. There's all kinds of information that's available right through the website. It's dreamex.com.
Perfect. Awesome. I'll put that in the description below. So, Joe, thanks again for your time.
Awesome. Yeah, thank you too.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.